The Petroleum and Natural Gas Regulatory Board has brought over a dozen gas pipelines, which form the national gas grid, under a unified tariff structure from April 1. This will likely benefit customers transporting fuel over longer distances and multiple pipelines. Earlier, customers used to pay additional tariffs for using multiple and interconnected pipelines. Under the new regime, buyers will be charged a fixed tariff for the transport of gas over 3 zones, up from 2 earlier. A levelized unified gas tariff of Rs 73.9 per metric million British thermal unit or MMBTU has been implemented, which incorporates the recent hike in state-run GAIL's integrated pipeline tariff. Analysts expect GAIL to be the biggest beneficiary from the development, given a 45% jump in its tariff, while it could be slightly negative for city gas distribution or CGD companies.
The PNGRB hiked the integrated natural gas pipeline tariff for GAIL to Rs 58.61 per MMBTU with effect from April 1, 2023. This is 45% higher than the current tariff. PNGRB has considered total 10 pipelines as a single integrated entity. The hike was aimed at incentivizing GAIL to expand its pipeline network and improve connectivity between the gas-rich eastern region and demand centers in other parts of the country. With the tariff hike behind, volumes will be the key driver of growth for GAIL. It expects tariff increase will aid overall EBITDA by Rs 1,600 crores at current volumes, but the firm will appeal to PNGRB to revise it as the hike given to it is lower than what it expected. It is slightly negative for city gas distribution companies that use the pipeline network, as the hike could result in higher prices of compressed natural gas and piped natural gas for consumers. However, they could fully pass through the price increase to end customers over time. Top picks in the space currently are IGL, Gujarat Gas and Oil India.
Nuvama Institutional Equities believes the impact of the unified tariff on CGD players will still be limited, as it constitutes just 2% of their selling price. According to Mahanagar Gas, passing on the cost could raise CNG prices by Rupee 1 per kg, though the company expects the impact to vary for players depending on their location. Meanwhile, the delay in implementation of the Kirit Parikh Panel's gas price mechanism disappointed the street on Monday, which was expecting the new norm to kick in from April 1. At the bourses on Monday, shares of IGL and MGL slumped up to 7% intraday as gas prices were left unchanged. Tuesday was markets holiday. The panel's pricing mechanism is expected to cap gas prices at relatively lower levels, which will significantly benefit CGDs in their margin recovery. Hence, investors are eyeing its implementation, which will remove a big overhang on the stocks. That said, CGD players are expected to have recorded firm margins in Q4 due to easing LNG prices. According to CLSA, IGL, Gujarat Gas and MGL should see strong margins in the January to March quarter, given a 50% fall in spot LNG price to $14 per MMBTU as compared to December. This has also led to a 2 to 3% monthly rebound in LNG demand, which will likely drive volume recovery for Gujarat State Petronet, Petronet LNG and GAIL. Today, the equity market will see global cues and keep an eye on the services PMI data.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.